we want to look at something related to our previous lesson. Remember, we were actually looking at the Australian tax system that is run by the Australian Tax Office. So I remember promising you that in this particular lesson, we were to look at actual calculation of taxes using the tables that are provided in the Australian Tax Office website. So today I want us to look at calculating income tax payable. Calculating income tax payable. The tax that one is supposed to pay. Income tax payable simply means the amount of money that an income tax earner has to pay to the government. That is what the term income tax payable, the amount of money that an income earner is supposed to pay to the government. It is some kind of a liability. This is actually calculated from the tax tables. These calculations are basically guided by the tax tables. The calculations are guided by the tax tables. And we ought to remember this, that for us to get the taxable income, for us to calculate the taxable income, this is basically the difference between gross income and the deductions. Even in our last lesson, we tried to look at the components of gross income. We said that when we are trying to look at gross income, this should be one of the things that contributes to our gross income is income from employment. And also we can have interests from investment. Interests from investment can also contribute to that. And you might be working somewhere full-time, but at the end of a given shift, you have something that you do, a side hustle, that can also contribute to our gross income. We can call it income from a casual job where you work part-time. These are just but some of the things that can contribute to gross income. And those ones that can contribute to deductions the first one we looked at was donations. These donations should be made to registered charitable organizations. Another one, the second one, can be expenses work related. We call them work related expenses. Work related expenses. So, having this brief information, I want us now to move on to examples so that we look at actual calculations of tax, income tax payable. We look at examples. And our first example is during the 2012-2013 financial year, someone by the name Richard and $1,050 per week, which actually translates to $54,600 per year. From his employment. And other sources. Such as interests on investment. He has receipts for $375 for work-related expenses, and donations. The first question is for us to calculate Richard's taxable income. The first question requires us to calculate his taxable income. Remember, for us to solve such a question, it is important that we write down the guiding rule or the guiding principle that I've just reminded you. That is taxable income is equivalent to the gross income minus the total deductions. Having written down this particular guiding principle, we need to identify the gross income from this particular statement. We also need to identify deductions. So that if we substitute those variables in this particular principle, we will be able to get our taxable income. From this particular question, Richard earns $54,600 in a year, in a financial year. When we are calculating this particular taxable income and matters pertaining to tax payable, we talk about a financial year. So in a year, his gross income amounts to $54,600. And the total deductions will include the receipts from the work-related expenses and also the donations. And that total we've been given is actually $375. So our gross income is $54,600, while our total deductions, that is the sum of work-related expenses and donations, is at $375. When we subtract this, we end up having a taxable income of around $54,225. This is Richard's taxable income. The second question that arises is for us to use the tax table to calculate Richard's tax payable amount. So with me here, I have a chart detailing the tax table for the financial year 2012-2013. So our second question, that is question B, use the tax table to calculate Richard's tax payable. Richard's tax payable. It is good that you have a copy of the tax table somewhere in your notes, because we are actually going to be using this particular tax table more oftenly as we proceed in this lesson and even the coming one or two lessons. So it is important that when we want to calculate the tax payable, there are a few things that we are supposed to look at. First of all, we need to identify his taxable income. We need to identify the taxable income. And in this case, the taxable income we have just calculated is actually $54,225. Having identified that, we also need to identify the tax bracket in which this particular taxable income falls. We need to identify the tax brackets. And in our previous lesson, we said that this is the first tax bracket, the second, the third, the fourth, and we have the fifth tax bracket. When you look at the issues to do with the tax brackets, they are basically like a story building. You have the ground floor, the first floor, the third floor, the fourth, and the fifth. And mostly when a given taxable income falls within the third tax bracket, we usually refer to it as the middle, because the other side we have two, this side we have two, so we usually refer to it as the middle or the third. So this particular taxable income of around $54,225 will fall within the third tax bracket. It will fall within the third tax bracket, that is between $37,001 and $80,000. It falls within there. That amount is between the range. Having looked at that particular tax bracket, the third thing is for us to know the guiding rule. How is this tax going to be affected? How do we calculate taxes in that particular tax bracket? How taxation is affected in that bracket. How taxation is affected in that particular bracket. And lastly, if you do all these things as illustrated here, we need to now move on and calculate the tax payable. We now move on and calculate the tax payable. Looking at this third or middle tax bracket, you discover that for every taxable income that falls within this particular range, we have $3,572 as the base tax, plus 32.5 cents for every dollar that one earns over and above $37,000. When you look at this particular amount, it is above $37,000. So for us to get the income tax payable, we have that base tax, which is $3,572. Then we are told plus 32.5 cents for every dollar, for each dollar above $37,000. So we convert this to a fraction or a decimal. Basically 32.5 cents means 32.5 all over 100. Then we multiply by the difference between the taxable income, and the higher limit in that particular tax bracket. So this will be the difference between 54,225, which is our taxable income, and $37,000. And this will give us, this difference will give us, this first of all will give us 0.325 multiplied by, let us get that difference. which is 17,225. This will give us a sum of $3,572 plus $5,598.125, and this cumulatively will give us $9,170.13, rounded off to the nearest cent or 2 decimal places. This is what we have. We need to identify the taxable income, in which we had already calculated in our first question. Then you look at the tax bracket in which the taxable income will fall within the tax table. Then you find out how taxation is effected in that particular bracket. You get that particular rule or the formula used. Then you move and calculate the tax payable in that particular bracket. Let us move on and look at the next question. That is question C. And the third question, we are told that Richard must also pay the Medicare levy. The Medicare levy. This Medicare levy is 1.5% of his taxable income. Of his taxable income. How much is the Medicare levy? How much is the Medicare levy? Maybe just a reminder of our previous lesson. We said that our Medicare levy is that amount that we contribute towards a certain pool controlled by the government that is used to run the healthcare system, to take care of all the citizens in Australia, so that those ones who can afford Medicare and those ones who cannot afford, both of them can be taken care of by that particular pool, where each and every income earner contributes every time they earn. So this particular question requires us to calculate the amount of Medicare levy that Richard is required to contribute towards the same. And we are saying that Medicare levy is 1.5% of the taxable income. Remember, how we get our taxable income is the difference between gross income and the deductions. So the moment we get our taxable income, that is the figure that we are going to use. And in this particular question, we have already calculated our taxable income. This, we are saying, is 1.5% of our taxable income. We calculated in the first question, and it was $54,225. And when we reach this particular stage, basically this means we want to get 1.5% of this, getting a percentage of given amounts or quantities we have learned in our previous lessons. And we said that for us to carry out this particular operation, we need to express this as a fraction or a decimal. And if I express it, this will be 1.5%, means out of 100. This is 1.5 out of 100. And the word of means multiplication. This one you already know. $1.5 out of 100 of $54,225. This will give us $813.38. This figure is a bit longer, but it has been rounded off to the nearest cent. To the nearest cent. So this is the much that Richard will contribute towards medical levy. So for those ones who don't work or who don't have any income, the moment they fall sick, they just walk into a hospital and receive treatment that are catered for by the medical levy. Let us move on to our next question. And our next question is add the tax payable and the Medicare levy amounts. It requires us to add the tax payable and the Medicare. We add them. This is basically a total. And this particular total basically gives us the amount that Richard should have paid in taxes. We are saying that this is the amount that Richard should have paid in taxes because the tax system keeps on varying. As we speak, it might have already changed. So that is why we are saying it is the amount that he should have paid. And this is basically the sum where we have the tax payable was $9,170.13, while the Medicare levy is $813.38. If we add this, we are going to get $9,983.51. So this is the amount that will be, that is the sum of the tax payable and the Medicare levy. Our next question is actually for us to calculate his net income. Net income. We calculate Richard's net income. And remember from our previous lesson, we had learned that for us to get net income, which is actually the income after all the deductions have been effected, this is supposed to be the difference between the gross income. This should be gross income. And when we talk about gross income, this is the income before the deductions are effected. And this is the income after the deductions have been effected. So here, what do we have? What do we have? This is basically the total deductions. Total deductions. And these total deductions should not be confused by basically the sum of donations, work-related expenses. No. When you talk about the total deductions, this can also include the pre-tax deductions. If you have taken a loan from your employer, they will also deduct. So what you end up is what we are looking for. And our gross income, Richard's gross income, that is, was $54,600. $54,600. And the total deductions will be the sum of tax payable and Medicare levy. And this we can calculate as $54,600 minus that figure. We actually have it, we've just calculated, which is $9,983.51. When we subtract these two, we will end up with a net income of $44,616.49. This is the net income that Richard will get. This is the net income that Richard will get. Our next question is for us to express the total tax. The total tax in Part D above as a percentage as a percentage of Richard's taxable income. We have already learned when we were looking at percentages on how to express given amounts and quantities as percentages of others. In this particular case, we want to express the total tax that Richard pays to the Australian Tax Office as a percentage of his taxable income. This means we are going to have total tax all over taxable income, and the same should be multiplied by 100%. When we multiply any quantity or any figure by 100%, we will be expressing it in percentage form. Our total tax is $9,983.51, and Richard's taxable income we have already calculated, which is actually the difference between his gross income and the deductions due to work-related expenses and the donations. And this one we calculated, we have it as $54,225. This should be multiplied by 100%. This will give us a figure of 18.4%. This is rounded off to one decimal place. It has been rounded off to one decimal place. What does this particular percentage mean? What does this particular percentage mean? It means that for every dollar that Richard earns, he is going to pay 18.4% as taxes. So this means for every dollar and 18.4% goes to taxes. That will be deducted as taxes, which is actually around 18.4 cents. For every dollar, Richard pays 18.4 cents as taxes. And those taxes includes the tax payable and the Medicare levies, both combined. And our last question is, during the financial year, Richard's employer sends a total of sends a total of $7,797 in tax to Australian Tax Office. So the question is, has Richard paid too much tax or less? Has he paid too much tax or less? If he has paid too much, then we need to calculate his refund. We call it tax refund. Or tax liability. So when we look at this particular statement, it reminds us of our previous lesson where we actually said that in the Australian tax system, you work for your boss, who is your employer, and the employer calculates the amount of money you're supposed to pay in form of taxes every time you earn, be it weekly, fortnightly, or monthly. And the employer remits the same to the Australian Tax Office so that the Australian Tax Office can remit the same to the federal government for expenditure. So in this particular scenario, Richard's employer has actually sent a total of $7,797 to the Australian Tax Office. But remember, we have already calculated the total taxes that Richard should have paid. So the tax that should have been paid is equal to $9,983.51. But the actual tax paid by the employer is $7,797. So in this particular scenario, we need to compare these two figures, the tax that should have been paid and the tax that has been paid. So if we discover that what was paid by the employer is less, then we said that Richard will receive a letter from the Australian Tax Office demanding for more taxes to be paid. And that is what is referred to as tax liability. More money to be given to the Australian Tax Office by a taxpayer. But in the event that what was paid is more than what is required, legally required, then the tax office gives a tax refund to the taxpayer. So in this case, when we compare the two, we discover that the employer paid $7,797, while the required tax is supposed to be $9,983.51. So this will actually show that Richard is supposed to pay a tax liability Richard should pay a tax liability. And this tax liability is the difference between the amount paid and the amount required. So this will be the difference between 9,983.51 and what was paid, which is 7,797. So Richard's tax liability is to the tune of $2,186. $2,186.51. And I hope this particular example will help us to understand the difference between tax liability and tax refund. When do we talk about the tax refund and when do we talk about the tax liability? So we have looked at how we can calculate taxes using the tax table. And that example that we have done have actually elaborated on how we can apply this particular tax table, and we can only use a certain tax bracket if only the taxable income falls within that particular tax bracket. And as we had looked at this particular tax table in our last lesson, we went through it. You know what it means. This particular first tax bracket, whereby those people who earn between $0 and $18,200, they don't pay taxes. Those who earn between $18,201 and $37,000 will pay 19 cents for every dollar they earn above $18,200. And in the third tax bracket, the people who earn a taxable income within this range will pay a base tax of $3,572 and an additional of 32.5 cents for each dollar they will earn above $37,000. In the fourth bracket, those who earn between $80,000 and $1 and $180,000, they pay a base tax of $17,547 with an additional of 37 cents for every dollar they earn over and above $80,000. And lastly, for those ones who earn an amount between above 180 and $180,000 and $1, they pay a base tax of $54,547 plus an additional of 45 cents for each and every dollar they earn above $180,000. It is important that you understand the information contained on this particular tax table, because if you don't understand it, you cannot be able to apply it. So to gauge whether you have grasped the content on calculating income tax payable, I have a question, and this question is actually just an adjustment of the example that we have used. And the question is, assuming that Richard earned a total of $86,000 per annum, and that his total donations including work-related expenses amounted to $600. That we assume that instead of what he earned was which was actually $54,600, this time round we assume that he earned this amount. And then instead of us having his total donations and work-related expenses being an amount amounting to $375, this time round it has increased to $600. We are supposed to answer the questions. Answer the questions from A to F, which was the last question. The last question is supposed to be G. A to G in the example above. In the example above, using the new figures. And also use the tax table. Use the tax table given. So if you have been keen enough in our first example, you will be able to look at these new figures. Instead of $54,600, we have $86,000. And instead of having work-related expenses and donations amounting to $375, this time round it is $600. So you need to use these new figures together with this provided tax table to answer these questions from the first one that we started with, which was for us to calculate the taxable income, to the very last one whereby we have been calculating whether Richard has a liability, tax liability, or a refund is required. So you need to go through the questions as we have just done in that particular example to answer this particular question. Remember, the tax table that we are going to use in this particular question, it is still the one that I've provided on the board. And it is still the same that we looked at in our previous lesson. I hope you have understood the concept, and in our next lesson, we will be looking at how do you calculate the taxable income if you are given the other variables. Remember, the taxable income is equal to the difference between gross income and the deductions, the pre-tax deductions, that is. So we will be looking at how do we calculate the taxable income if we have been given these other variables. So it is some kind of working backwards. Up to that point, thank you so much and welcome in our next lesson.